Good morning. My name is Rob Newman. I am the tax partner of Carter, Collins and Meyer, and I am delighted today to say I have one of my best professional contacts with me. I have s.Jones from Absolute Recovery Insolvency Practitioners. Steve and myself have been working together on cases and jobs for probably about 10 years now, and I have never been privileged to meet an insolvency firm as good as Absolute. They have provided some of the most commercial and client-orientated advice that I have seen across the years, obviously all within their own confines of their professional services. Good morning, Steve. Welcome.
Morning, Rob. Thank
Please
you.
introduce yourself. Tell us a little bit about Absolute Recovery, how you've ended up where you are and what you do.
Basically, my name is s.Jones, Director of Absolute Recovery. I initially worked for the Inland Revenue, went into insolvency, and approximately 10 years ago, we set up Absolute. It's a small family-run firm. We hope that we give the best advice possible. And there isn't any job that's too small or too big. And we're more than happy to discuss any and every scenario due to the fact that every company and every insolvency is completely different. It is a case that, whether it be Joe Bloggs who's got a one-man band or someone who's got 100 employees, each company that goes into an insolvency procedure or needs some sort of restructuring will be different, however you look at it.
I think that's really true, and I'd reiterate what you say. You've worked across the whole of the UK for clients for me in the past, and I know you've done other cases across the whole of the UK, and you've been very willing, and which has been brilliant, for just have an informal chat with somebody that's ended up in some sort of difficulties, financial or otherwise, and you've always been really willing to just pick up that phone and talk to them, to come up with something that will help. What's a typical case for you? What's the typical situation where you'll end up that phone ringing, you answering it?
It's basically that, in the past, it would have been a winding up petition that's been issued on a company. However, at the present moment, they've been stopped. But it's typically that if a company, the director is completely at the wit's end, they don't know what they're doing, they don't know how to get out of anything. It can be just a simple, straightforward conversation to say, right, what is your situation? Let's see, basically, where do you want to get to? Do you want to keep running the company? Do you want to walk away from the company? As I said, every company is different. Every director wants something different. So at the end of the day, it's working with the director and working with their accountant or whoever's put us in touch with them to get them to the point of, we want to get to point Z. Right, we'll start from A and we'll work our way through. It could be a company voluntary arrangement where they want to pay back over a period of time.
Yeah, I'm sorry to interrupt, but that's a great thing. For the people that are watching this video, a lot of them are not going to be familiar with some of the terms that are used in this. Talk us through a couple of the different types of insolvency things, from very informal through to very formal, all the sort of different types of things that are within your toolkit.
Basically, you've got different things that you can do. If you want to keep hold of the company as it is, you could potentially do what's called a company voluntary arrangement, whereby all your unsecured debts are put into a pot and you make a proposal to your creditors over a period of up to 5 years to repay back to your creditors. So you pay into the CVA each month a set amount that's agreed by creditors.
It's usually a percentage of the total as well, isn't it?
It can be. It can be anything. It's what it has to be is what the company can afford. There's no point in going to creditors and going, we're going to pay you back 2 pence in the pound, because they're not going to accept that. Yep. It has to be the company's best offer. The closer to 100 pence in the pound, the quicker it can be repaid, the better it is, because the more acceptable it will be to creditors. Yep. If you're talking 40 pence in the pound, it depends on who the creditors are, whether they can take that hit and whether they're willing to wait the 5 years at 40 pence in the pound.
Yep.
There has been a change in the insolvency rules over the past, well, since April, HMRC have now taken back their preferential status.
I think that's really important for people to know as well, because I
Yeah.
mean, that's going to impact on some of the stuff that I want to ask you later, that preference that HMRC now have again.
It does. It's only certain parts of it, but it's virtually the majority of what your HMRC debt is, because they've worked it so that it is basically what's mainly incurred with them, and that part then becomes the preferential status. So in a company voluntary arrangement, you have to pay off the preferential creditors first before anything goes to unsecured creditors.
Okay.
So instead of it being all pari passu across the board, where you pay, if it's 10 pence in the pound, you pay it to absolutely every creditor, including HMRC. HMRC take their 100 pence in the pound for preferential first. And then if they've only got a £20,000 debt after being paid 100,000 already,
yep,
that's the only unsecured part that goes along with the unsecured creditors. So in effect, what it's done is it's increased how much a company have to pay into a CVA,
yep,
due to the fact that to get anything back to unsecured creditors, which really you should be doing, you've got to pay preferential status first.
That must have had quite an impact on the usage of CVAs and the uptake that you're seeing of them, because as you say, it's putting an awful lot more strain on what people are going to end up having to pay if they're going this voluntary route.
It does. There are ways of doing it where you can start off by paying so much per month in the first year and increase it as your profitability increases, which when you're in a company voluntary arrangement, you've got to supply your accounts each year. And if there is surplus profits, those have got to be introduced into the company voluntary arrangement anyway, or 50% of surplus profits.
Mm-hmm.
So if a company thinks that at the present moment, due to COVID, it's a case of, we've got problems, we can only afford to pay £1,000 a month, but next year, when all the COVID restrictions are eased, our profitability is going to go up and it's going to be £2,000 to £3,000 a month we can afford. You can write that into the proposal.
So that's very flexible then.
It can be, yeah. It can be. Obviously, HMRC are usually the main creditor.
Right.
90% of the time, HMRC will be the main creditor. So they would have the vote as to whether it's accepted or rejected. You do have 2 votes at a meeting of creditors of the CVA. The first one includes all connected parties and associated parties. So if you've got a director's loan account, that goes towards it, and you need more than 75% in favour.
Okay.
At the second vote, you take out the director's loan account and associated creditors, and you need more than 50%.
So that second one's just third parties, people that are
just unsecured creditors that are not associated or connected to the company or the director in any way.
Okay.
So as long as you get that through, it's then accepted by creditors, and all creditors are bound by the arrangement, whether they wanted it or not.
Yep.
They are bound.
There's still a lot you can do within that, isn't it? Because I mean, over the last few years, you've had a lot of like retail companies get rid of leases and completely restructure and reorganize their businesses in so doing. Is this something that a smaller business, that the type of which I certainly deal with, would find useful to reorganize and restructure themselves?
You can do, or you can certainly try to. The problem that you've got with the bigger companies, the likes of Debenhams and people like that, where they did a CVA and got rid of some of the leases in the company, is they were big companies. They were in the public spotlight. So there was more impact on the landlords to agree so that they could continue with the name, the brand. I think it would be a bit more difficult for a smaller company to go, I don't need that lease.
Yeah.
Because that creditor, the landlord, may be more than 25% of the vote.
In which case,
you would have to get them on side, and they're not likely to do that. They're going to turn around and go, well, no. So if it's like a company with two leases and you want to get rid of one, you could potentially try it, but you would have to seriously look at whether you would be able to get the landlord on board to allow you to get rid of the lease. They may have someone else interested in it, which would be great because they'd allow you
Days, yeah.
Yeah. But I think it would be quite a bit more difficult for a smaller company. I think that mainly works when it's a big high street brand and things like that, where if they go down, there's going to be a public outcry.
Yeah.
With the likes of Debenhams.
So on smaller companies, then there is going to be that these are not as useful, perhaps, as the press indicates they potentially can be for bigger companies. You're moving more into full formal restructuring. Do you believe?
Not necessarily. Not necessarily. If a company thinks it is, they've got quite a lot of assets and they know they're profitable. It's just that there's been a blip, and COVID has been a big blip.
Yeah.
I think creditors will be a lot more, we're going to get our money back, rather than the company going to liquidation, where the likelihood is they're going to get virtually nothing.
Yep.
And HMRC have still got the preferential status in liquidation.
Yep.
So, a CVA is a lot more beneficial to creditors because the payment in the pound has got to be more than in a liquidation. So,
understood.
For companies with assets, I think that would be potentially worthwhile looking at and taking the advice on that.
Okay.
Every single company, as I say, is different. There is no point in me sitting here and saying, if you've got assets, CVA it. If you've got assets, put it into administration.
Yeah.
Without looking at each specific case, I will not give that advice. I want to look at how is it going to be profitable? Is it worthwhile saving? Is there a better route to doing something else? There are so many insolvency procedures that you can do that may be of more beneficial interest and be able to get the company or a new company back on track a lot quicker, which then brings in more revenue for HMRC because you're employing people quicker and writing off debt. It just depends on what that company needs and where that director wants to be.
I think that's a really important point. I mean, we both worked on a case last year for a local brewery where the directors didn't want to be involved in the what happens next, did they? The directors in that case very much wanted to be removed from the scenario and step it on. And although certain insolvency procedures from the outside would have appeared brilliant for them, it went down a totally different route. So I think it's very important to look at what that individual wants, which is why, as I say, I've always been so happy sending anybody down to Absolute Recovery and yourself, because you've always taken the time to do that.
Yeah, it was a case of, obviously I don't mention cases, but it was a case that the directors wanted the company to survive, but they didn't want to be part of it. And then when you start on one route, potentially administration to sell it as going concern, and you get interested parties, it then could, as it did this time, the interested parties didn't want it to go into admin.
Yep.
So a deal was done before it went into admin.
And as I say, I mean, in that particular case, it was very successful. You saved the company with what you did.
Yeah.
Please talk about admin for those that are in administration, because again, for the viewers of this, they're not going to be familiar with what that actually entails, what it's about, what it means.
Okay. Administration. This is, to me, an expensive insolvency route, a very expensive insolvency route. And again, when you're looking at the likes of Debenhams, it works for people like that. An administration is when you want to sell it as a going concern, or it's a better realization for creditors, or to pay off a secure creditor. The expense of an administration far outweighs, to me, doing something unless you're a very big company.
Okay.
To me, you've got to have basically quite a lot of assets, or you've got to have a brand that you can sell on and things like that. How can I put it? Some companies will put companies into administration and sell the assets, and it's £5,000. That's not what an administration is for. There have been new rules coming into administration about selling to connected parties and things like that. So they're tightening it up a lot more. Unless a company has got a brand or a product, a lot of assets where, yes, they are insolvent, but it can be sold on and it can be run as was Debenhams and people like that.
Yeah.
That does work. But for small companies, I think they would be more looking at a liquidation and then setting up again.
Yeah, because there isn't the same disruption to the brand as you would get with, not that this company has been anywhere near this, but suddenly if Marks and Spencer's suddenly closed down and tried to reopen again later,
it wouldn't work.
It wouldn't, yeah.
So that's top of the tail.
It's more that type of company that would go into an administration to keep it going whilst something is dealt with.
Yeah, yeah. For some people it would work, like the brewery. There was a business there, but they were in difficulty because of COVID.
Yeah.
And it was a saleable asset. And there was quite a lot, when you've got like secured properties in there and, property with a mortgage on, you've got assets in there with finance on, and it can be sold like that, then great. Where you've got no assets, it is absolutely pointless at looking at an admin.
And let's be honest, most small companies nowadays don't have very much in the way of assets.
They don't. It's a lot of the time, it's, if you've got assets, it's vans on finance or things like that, photocopier on finance. It's not, a saleable, someone coming in looking at that, where I've got 15 vans on lease and no other assets whatsoever, I've got no stock or anything, I've purchased that.
What's the point?
Yeah. There's no point. You're not going to get a sale of that, because all you're taking on is, finance.
Yeah. I think that's something that's changed a lot since I first came into accountancy. I mean, I came into accountancy in the early 1990s and initially actually was in an insolvency department of the firm I trained at. And you used to find then small companies used to own everything, and they might have a small bank overdraft, and invariably it was the bank that was forcing the insolvency procedure, but they actually owned buildings and vans and plant and equipment and everything, and no one owns anything anymore.
No, it's a case of, I think people have got wise to the fact, and if there are assets, it's owned by a different company.
Yeah.
And that's what you find, or it's personally owned by the director, or, but obviously that would have to be proved if an insolvency procedure happened. And that's why you do face-to-face. It's why you're on the phone to potential clients and running through everything before you even do anything, because you need to know the full picture. And whether it takes half an hour where it's a company with absolutely no assets, or whether it's 3 weeks when you're going through everything to help them out and this, that, and the other, whether it ends up in it as a job, it doesn't matter. As long as you can help someone and get them out the other side, it doesn't bother me. I've been to Hastings for a day and come back with no job. But they knew which way to go.
Yeah.
And to me, that's fine.
I think I was going to say, you've also hit on a point that I say to everybody, please tell me, please tell Steve, please tell your advisor everything. We can't help. If you try and hide something in it and it then later comes out and blows up, it's 10 times worse. It's like the politician getting caught in the lie. It's not the original affair that was the problem. It's then the hiding of it and changing the records that become the problem. Totally. Please do. If you end up in financial difficulties, tell us, tell me, tell Steve, tell us all of it. Tell us everything. we're not going to judge you for it, but we will then be able to advise accordingly, even if that advice is getting you out of problems. If you have transferred something to yourself at the last second thinking you're going to save it from this liquidation, that can create a world of problems down the line for you. It's
Exactly.
so much better to do it. So the final stage, before we get into some of the advice around it and the current issues, liquidation. What is a liquidation? What types of liquidation? What does it mean?
Liquidation is basically where the company has come to an end. You can't save it, and basically there's too much debt to repay. So what you're going to do is, in a creditor's voluntary liquidation, where the director places the company into liquidation due to the fact that they owe 50,000 HMRC debt, they owe creditors, and they can't afford to repay it, or they just want to walk away from the company, the director would place the company into a creditor's voluntary liquidation. It's a straightforward procedure. It takes approximately 10 days to place the company into liquidation. Notices are issued. There is to all the creditors, which is signed by the director. There is then produced a statement of affairs which shows the assets the company owns, the liabilities the company owe, and that's then sent out to creditors. And then on a date that is basically chosen by the administrator in the office, they would then have that as what's called a decision day. There is no meeting of creditors anymore unless a creditor objects to the liquidation and wants a meeting of creditors. It's now classed as a decision day. For some unknown reason, the time of the decision is 11:59 p.m. 1 minute to midnight.
Right.
On a day. So if there's no objections to the liquidation, it's automatic. The company automatically go into liquidation at 11:59 p.m. So midnight the next day, it's in liquidation.
UK law is amazing, isn't it? The absolute sort of finicky stuff that UK law comes out with.
Well, it used to be that the meeting of creditors has to be held between 10 and 4 p.m., 10 a.m. and 4 p.m. Great, because then you've got your decision. At 11:59 p.m., it's not like people are going to be staying up waiting for that. The next day you've got to then do all your paperwork.
Yeah.
But once it's in liquidation, it relieves the director of all the duties. The company's in liquidation. Obviously, the insolvency practitioner then writes out to the director with a couple of questionnaires that they need to fill in. They request the books and records, which the director needs to send. And then the insolvency practitioner does their investigation. Every insolvency practitioner has to do an investigation into the trading of the company and the director. That includes the official receiver. So if it went into compulsory, where a winding up petition was issued against company, it wasn't dealt with. It went into the company was then wound up by the courts. The official receiver would take it on. So every insolvency practitioner has to do the investigation. They have to do the questionnaires, and they have to do a report to the old DTI.
What's all that for? What's that? That work that you have to do, that inquiry, that investigation? What's it actually for? What are you trying to show?
You have to show that the director has not done anything wrong while they're trading the company, that there's no misfeasance, that there's no preference payments, that there's no wrongful trading. However, wrongful trading has been stopped for quite a period of time since the winding up petitions were stopped. I think there was a 3-month period where a director could get done for wrongful trading in that last 18 months.
So those three phrases that you've used there, can you give examples to people watching this? What would be misfeasance? What would be wrongful trading? What sort of things? Draw on, if you can, without going into the specifics of the case. Give some like stuff that's happened.
To be honest, Rob, a lot of the misfeasance, wrongful trading does take a solicitor to prove. It's not something that you will come across day in, day out. The main things that you will come across overdrawn directors' loan accounts.
Which is, again, for the benefit of people watching this, where you
Where,
have taken more money out of the company than you have been able to declare as a dividend or a salary.
correct.
And unfortunately, as an accountant, I see that quite a lot, particularly in the last year or two. The classic being where you've taken a bounce back or a C-bills, drawn on it for yourself, spent it on yourself, but not then made profits enough in the company to have dividends or salary.
That's correct. The one thing that we do see quite a lot of is that where the director has been taking money out of the hole in the wall, but not allocating it to their accountant each month.
Yeah.
To say that I've taken part of my wages, or it was part, wherever it were. And if you're taking money out of the hole in the wall and you've got no record of this was used on supplies, it's going to go against your director's loan account.
Yep.
So a lot of directors unfortunately do it where they're taking out money, £500 to go and pay one of the suppliers, because obviously they're in the position where it's cash on delivery, and they're not keeping the receipt, or they're not supplying it to the accountant and saying, this £500 took out of the hole and wall was in relation to that receipt. So
they've then ended up in difficulties. They've then not spoken to the accountant about it to produce any records. They then end up with you. You rightly have to then start inquiries into it. And the next thing is they're facing a misfeasance.
Yeah, exactly. And the other thing that they do is, rightly or wrongly, some accountants do it, some don't. At the end of each year, wherever the director's loan is, it's then translated into dividends. If the company haven't made the profits to cover those dividends and subsequently goes into liquidation, those dividends can be classed as illegal dividends and called back into the liquidation by the liquidator.
Which can be a big shock for people.
It can be, yeah.
This is one of the things that people really struggle with, that it can be 2 years ago you've taken money out of this company, but because of the way a set of accounts and the length of time it's taken to actually get to you, because particularly in the last year, it's a year before you need to formally do a financial set of statements to it. 2 years later, you're turning around going, you need to repay all this to the company.
Yeah. And that can cause massive problems. We've had cases where the shareholders' funds are in minus, but they're still taking dividends.
Yeah, which
is totally an illegal dividend.
Yeah.
So it does have to be repaid. So there's different things that when you look at a set of accounts and what have you drawn and how have you done this, I'll keep on banging on about this, but every single company, every director is different. And you have to look at each case on an individual basis, because not one case that I've come across is exactly the same as another.
Yep. I think that's what makes your job fascinating. I think it really is, because you do come across, and I know for a video like this we can't get into some of the cases, but we both see some weird and wonderful stuff. But I think what you're particularly emphasizing there, and I'm going to pick up on, is keep your records up to date, particularly if you're in financial difficulties. Particularly if the company is struggling, it's even more important to invest that 2 to 4% of turnover into financial systems, be it through your accountancy firm, be it through bookkeeping, be it through whatever you need to do, to actually have good quality information to both be able to present to someone like Steve to help you and then to keep you out of difficulties later.
You see, to me, in business, if you're finding it difficult at the present moment, I know I'm saying pay out money here, but it would be in my interest, if I'm running a company and I'm thinking it's not going too well, to have my accountant do management accounts each month.
Music to my ears.
To keep, because someone like you will come along and each month do the accounts, sit down and go, you've got a problem here.
Yep.
Now, if it happens next month, we've got a major problem.
Yeah.
But people don't. 12 months down the line, you've had 12 months problems of this.
Yeah.
But you've still been taking money out.
Yeah. People don't understand how powerful management accounts are. I went into a business I think it was actually the very first case that you and I ever got involved with together. And I went into the business in October 2011 and sat there, did the management accounts and did some forecasting for the future. And by the middle of November 2011 said, in February 13, this company is going to go bust. And it was February 13, the company went bust. Because right. You can see it. You can.
And, it could have been a restructure, a simple restructure.
Yeah.
Right, we don't need this, so we can get rid of that. That bit goes into the company voluntary arrangement and we'll pay it off over a couple of years. But people do leave it and put their heads in the sand.
Oh, completely. I mean, that particular one was a prime example. The main director was spending £50,000 a year on flowers and for reception for the building, had a £600,000 office, and was actually ordering his breakfast, lunch, and dinner from a nearby restaurant to be delivered to the office, whilst then going to that restaurant to sit in it, to eat breakfast, lunch, and dinner, and put all of it through the company.
Yeah, that doesn't work.
Exactly.
It doesn't work.
But that particular director in that particular company felt he had to live to a certain standard to impress the people he was dealing with. And you could see it coming from a mile off. Now, I know they're not always as obvious as that one. They're not. But financial records are so important.
Yeah, it's most or a lot of the people I do come across, there is an obvious reason why they're in financial difficulty, whether it be COVID or in the past that, they've had a major supplier or a major contractor who's pulled the plug on them. And you do feel sorry for some people, but I can't, in the business that I'm in, I can't feel sorry for them. It's showing them the way forward.
Yeah. And again, I stress this. I think Absolute Recovery and yourself are superb at doing that. Being commercial to help them recover from where they're at, what with the situation they've ended up in. Again, I know another case that we had. The guy supplied a major corporate. He was there. They were 90% of his thing, and it was a food item. It was burger buns he was supplying to a major corporate, and the major corporate gave notice and said, "Thank you very much. In 3 months' time, we no longer need you." And the chaos that this guy ended up in, it went on for years and years while Steve was helping to try and sort out all the massive ramifications that then followed. That wasn't his fault. That was nothing to do. There was no decision he made in that. There was nothing he did wrong. It was, if you wanted to be super critical, well, don't have 80% of your business to one major corporate, I suppose. But I think actually in that circumstance, one of the terms and conditions of the corporate he was supplying with burger buns is that he did have to have 80% of his business with them. They wouldn't allow him to do anything else.
No, that is the problem. And you do come across that quite a lot, that, you have one thing that goes wrong. And whether it be a big company, I'll keep on banging about Debenhams, but someone like Debenhams who owe a supplier a lot of money because they've been supplying them with all the stock and everything else. There was so many, when Debenhams goes down, it brings on ramifications it's for a lot of other companies. And
it goes all the way down the chain, doesn't it, when you get that?
Yeah, and that's where we end up with, what was the reason for you going into liquidation? And you can work out by going back up the chain exactly what it was.
Yeah.
And it's quite obvious. But, with at the present moment with COVID, and we're hopefully coming out of COVID now, it's going to have more ramifications because we're going to be losing the furlough scheme in September. You've got the VAT has to start being repaid.
Yeah.
if it's not started by June, then the full amount's got to be repaid. The wind up petitions are due to come back on the 1st of July. And I think when those come back, it will be an avalanche.
Yeah, so do I, for what it's worth. I mean, I know of loads of companies that are storing up financial difficulties. And I think that at the moment, the winding up petitions come back, I think that's where it's all going to suddenly turn up on your door.
Yeah, well, I've seen a massive increase in county court judgments being issued. So I think people are gearing up, ready for as soon as winding up petitions are available,
Yeah.
they will be. And I've been talking to solicitors who have said exactly the same. They're constantly on a daily basis being asked, when can we issue a winding up petition? So it will be pretty soon. But I have seen, and if the wines don't come back, I have seen quite a lot more VAT bonds being issued.
This is a really big one. I mean, having had a number of clients hit by VAT bonds, please explain to the audience what a VAT bond is and what it means.
Okay, a VAT bond is where you've not paid your VAT for however long it is. The VAT will come along and say, we're getting a bit nervous. Due to the fact that you owe X amount, we want to issue a VAT bond on you. The VAT bond will be up to 6 months VAT that the company pay in a year. The company then have to pay up front to the VAT, or in certain circumstances, VAT will allow you to give a personal guarantee. So the director gives a personal guarantee.
Ooh, yeah,
No.
yeah.
If
you think about, just think about this for the viewers. You're being asked to pay 6 months of VAT up front before you've actually done anything, and you're probably in financial difficulties anyway, which is why you're not paying it to start off with. This is a major blow. Effectively, in my opinion, you're being closed down.
It basically is. It's basically, how I look at it is, it's like issuing a winding up petition.
By the back door. It's a clever winding up petition.
It is. But, there are people who they're not paying the VAT. The VAT know that. But if you do not pay this VAT bond up front or give the personal guarantee, you're not allowed to then trade.
Wow.
It's illegal to trade.
Think about that. If you're watching this, think about that. You get a document that is making it illegal for you to trade.
There's a set period of time that you've got to do it, or potentially you can go back to the VAT to discuss with them. But if you get issued it, it's pretty adamant that, VAT think that there's something wrong, and it potentially is disastrous for a company. Talking to the VAT may help. I can't see it because I've seen so many of them. I've seen people actually discuss it and get round the situation by obviously talking to the VAT. But a lot of the people who the bond have been issued on have already put their head in the sand.
Yeah.
And that's the problem that you've got, because you've not spoken to the VAT or the Inland Revenue, and you get these bonds, it's because you've not spoken in the first place.
Yeah. That's, again, I would reiterate that even from the accountancy side to it. It's the more financial difficulties you're facing as a business, the more important it is to stay on top of your compliance, to put your tax returns in, to put your accounts in, to have financial information available. The more willing and receptive, certainly HMRC will be, even from the work I do as a tax partner.
Definitely.
If all of your returns are up to, even if you're not paying them, if all of your VAT returns are up to date, I've got far more ability to negotiate a deal for you under a time to pay.
Yeah.
Because they know exactly what the picture is. If all of your, if I'm walking into somebody that's struggling before we've spoken to you, Steve, but they're struggling at this stage, and I've got all of your corporation tax up to date, all of your accounts filed, all of your VAT and all of your PAYE filed, even if you haven't paid it for 6 months, I pretty much am going to walk out with the time to pay. Certainly in the last 18 months, of time. HMRC have been very, very receptive to those type of people. Yeah, okay, no problem. We can do X, Y, and Z. We can spread it. I mean, I managed to get £100,000 of tax, because there was VAT and PAYE and everything, spread over 5 years with no interest from HMRC about this time last year. And an absolutely amazing deal. It's a 5-year interest-free loan, effectively. But they were absolutely on their compliance. Everything was up to date in terms of file documents, and their history was perfect as well.
Well, that's what we found a lot of the time. You know, HMRC will only issue a winding up petition as a last resort. They want the money in. So they're very receptive if you go for a time to pay agreement. Obviously, there's time constraints on it. They used to give 6 to 12 months.
Yeah, that's the normal. I mean, the last year has been unusual because of COVID. Yeah.
But they are offering that. That's why they offered the VAT deferment. But you will get companies who've taken that VAT deferment and they're never going to pay it back.
Yeah.
Because the business isn't there.
Yeah.
A lot of the things that we're seeing are the hospitality, because it's still not open. And it's all right, the furlough scheme, but with directors now having to pay towards it as well to top it up, it's going to get more and more difficult, and a lot of people won't be able to afford it. So it is going to close the business, because, you know, I know of a hotel that, you know, they're getting £3,000, was it a month, off the government. It's £100,000 a month to run it.
Yeah. Yeah.
It's impossible.
I mean, there's been some big public cases of this. Rick Stein, the chef, has publicly posted up videos that he came as close to going into liquidation as you could come, despite having a multi-million-pound empire. The cost of keeping his infrastructure going, he had to abandon several of his restaurants, and he's been very public about it. So, you know, if you're in a small business, don't think that you're alone with this. This is large organizations have suffered the same as you, but get advice early. Contact Steve, contact myself. Very neatly, because I am conscious of time on this, this has led into the effects of coronavirus. People have had CBILS, they've had, which is coronavirus business interruption loans, they've had bounce back loans, they've had furlough. I think there's going to be an avalanche of inquiries into furlough in the next year or two from HMRC. I think there's loads of people need to talk to me about that. If you've claimed furlough and it's wrong, or you shouldn't have done, HMRC have told me that provided it's been repaid by the 31st of January 2022, they're not going to impose any interest or penalties informally. Formally, that's not their position, but informally, they've said, look, we just want to get this sorted out and get it straight. If you think that you have got issues, if you know that you've done it wrong, come and talk to me. We can sort it out before then. If you know that you've got issues with your business, you've had bounce back loans, repayments are starting to hit now, you've had VAT deferral, and you just know there isn't a business there, Steve, what should they be doing? Contact me straight away. Contact me, speak with me. You know, I'm more than happy to come out and meet people, sit down with them. You know, I can come to your office, Rob, and sit down with them there, or at our office. My mobile number is always on, which is not usual for a company. My mobile number is 07855 455 612. You can contact our office on 01302 572 701, or just drop me an email at s.jones@absrecovery.co.uk. I will put that in the links underneath this video as well, just so everyone can see it. Any financial difficulties, please do. Steve, it's been really good talking to you. Please stay on the line just once I've stopped this, so we can catch up for a few moments. Guys, financial difficulties at all, if anything's going wrong, some really great advice and steps to take in terms of what you need to be looking at and doing. Get your financial affairs together, get information up to date, talk to your accountant, talk to me first, get on to Steve if you know that you're struggling. I will happily, as I say several times through this, and again, endorse his firm for the great commercial advice they've given to everybody. Thank you so much for watching. My name has been Rob Newman. I am the tax director of Carter, Collins and Meyer. The best way to get hold of me is inquiries@uk-ccm.com. That's inquiries@uk-ccm.com. Thank you so much again. See you in the next one.